How the U.S. Treasury market almost collapsed in 2020, the crisis nobody reported on. Imagine waking up tomorrow and discovering that the safest financial asset on earth suddenly had no buyers. Not Bitcoin. Not stocks. Not real estate. The United States Treasury. The market that governments, banks, billionaires, and central banks trust more than anything else was only days away from breaking. If it had failed, ATMs could have stopped working normally, businesses might have struggled to borrow money, and the global financial system could have faced a crisis unlike anything seen since 2008. Almost nobody remembers it. Almost nobody even heard about it. Because while the world was focused on a deadly pandemic, a far more dangerous financial emergency was unfolding behind the scenes. This is the forgotten story of how the U.S. Treasury market almost collapsed in 2020. In early 2020, fear spread across the globe faster than anyone imagined. Countries shut their borders. Airplanes were grounded. Entire cities went into lockdown. Millions of businesses closed almost overnight. Financial markets reacted with panic. The Dow Jones suffered some of the largest single-day drops in history. Investors watched trillions of dollars disappear in a matter of weeks. But behind these dramatic headlines, another crisis was quietly taking shape. One that threatened the foundation of the entire global financial system. To understand why this was so dangerous, we first need to understand what the U.S. Treasury market really is. When the U.S. government needs money, it borrows by issuing Treasury securities. Investors buy them. In return, the government promises to repay the money with interest. Sounds simple. But these securities are far more than government debt. They are considered the safest financial assets in the world. Banks use them as collateral. Central banks keep them as reserves. Insurance companies depend on them. Pension funds invest trillions of dollars in them. Foreign governments hold enormous amounts of them. Even interest rates for mortgages, student loans, and business loans are influenced by Treasury yields. Every single day, trillions of dollars flow through this market. Without it, modern finance simply cannot function. For decades, investors believed one thing with absolute certainty. No matter what happened, Treasuries would always remain liquid. There would always be buyers. Then came March 2020. As COVID-19 spread across the world, panic reached levels not seen in generations. Investors sold stocks. They sold corporate bonds. They sold commodities. Normally, when markets panic, investors rush into Treasury bonds. That's exactly what happened during previous financial crises. But 2020 was different. This time, investors weren't looking for safety. They were looking for cash. Only cash. Companies suddenly needed money to survive. Investment funds faced massive withdrawals. Banks prepared for uncertainty. Everyone wanted US dollars immediately. And to get dollars, they started selling everything. Even Treasury securities. At first, this seemed impossible. How could the safest asset on earth suddenly face too many sellers? Yet that's exactly what happened. Selling pressure became overwhelming. Dealers who normally bought Treasury bonds simply couldn't absorb the enormous volume. Bid-ask spreads widened dramatically. Liquidity began disappearing. Prices moved in ways that shocked even experienced Wall Street traders. Large transactions that normally took seconds became difficult to complete. For a market known as the deepest and most liquid in the world, this was almost unimaginable. Veteran traders later described those days as some of the most chaotic moments of their entire careers. But COVID wasn't the only reason behind the crisis. The real problem had been building quietly for years. Many hedge funds had been using an investment strategy known as the basis trade. The idea sounded simple. Borrow money at extremely low interest rates. Buy Treasury securities. Profit from tiny price differences. The profit on each trade was small. So funds borrowed enormous amounts of money to make the strategy worthwhile. As long as markets stayed calm, it worked beautifully. Until volatility exploded. As prices moved violently, banks demanded more collateral. Margin calls spread rapidly. Funds suddenly needed cash. The fastest way to raise cash was to sell Treasury securities. That selling pushed prices down even further. Falling prices triggered even more margin calls, which forced even more selling. A dangerous feedback loop had begun. The more investors sold, the more they were forced to sell. Within days, the Treasury market, the very foundation of global finance, was showing signs of serious stress. And if that market stopped functioning, everything else could have followed. Banks rely on Treasury securities every single day. Money market funds depend on them. Large corporations depend on them. Governments depend on them. Even international dollar funding depends on them. If Treasury trading froze completely, credit markets could freeze. Businesses might struggle to borrow. Governments could find it harder to finance emergency spending. Financial institutions across the globe could face severe liquidity shortages. The consequences were almost impossible to predict. The Federal Reserve understood the danger immediately. It realized this wasn't simply another stock market crash. This was a systemic threat. So it responded with extraordinary speed. The Fed announced that it would purchase Treasury securities on an unprecedented scale. Not billions. Hundreds of billions. Then even more. At one point, the central bank was buying Treasury securities at a pace never seen before in American history. The goal wasn't to boost stock prices. The goal was to restore confidence. To make sure buyers returned. To ensure liquidity flowed again. To prevent the foundation of the financial system from cracking apart. Slowly, the panic eased. Trading conditions improved. Bid-ask spreads narrowed. Confidence returned. The Treasury market stabilized. Most people never noticed what had happened. News headlines focused on lockdowns, hospitals, vaccines, stock market volatility. Almost nobody discussed the hidden battle taking place inside the world's most important financial market. Yet many economists now believe those few weeks represented one of the closest calls since the 2008 financial crisis. Some even argue that without the Federal Reserve's intervention, the economic damage could have become dramatically worse. The biggest lesson from March 2020 wasn't that stock markets can crash. We already knew that. The real lesson was something much more unsettling. Even the safest market on Earth can break under enough pressure. The global financial system doesn't run on money alone. It runs on confidence. And for a brief moment in March 2020, that confidence almost disappeared. The next financial crisis may not begin with a stock market crash. It may not begin with banks. It may not even begin with housing. It could begin where almost nobody is looking. In the market the world believes can never fail. And that's exactly what makes it so dangerous.